When you make money, we make money. By the trader, for the trader. The reality is, as you already know, prop firms are not really on our side. Now, they're a beautiful tool, wonderful opportunity for any trader to be utilizing because you can access larger capital and capitalize on a skill set. But the problem is, the prop firms are not on our side. As we know from the business model, they make money when we lose money. Therefore, they are going to put hidden tricks in place for us to trip over, for us to fall and keep lining their pockets by buying more and more challenges. And in a previous video, we spoke about how they do that. Various gamification methods, remember the leaderboards and the certificates, and we spoke about in that video how prop firms do these things for the only reason to get us emotional, to get us playing on our status and competing with one another. All of these things feeding negatively into our psychology and framing us in the wrong way as traders so that we are more likely to blow accounts. So in this video, I'm going to go through the red flags of prop firms, the hidden tricks that they are doing that are only there for us to keep losing money. Once we are aware of this, then we are armed. We know which prop firms to avoid, and we know how to build a strategy around these conditions so that we do not fall victim to these unfavorable conditions. Now, the first one that I'm going to mention is the 3 types of drawdown. Now, when I found about the 2 types of drawdowns that certain prop firms are doing, it actually made me angry. I was like, what the f is this? This is only there to make traders fail, and we should also completely avoid the prop firms that are utilizing the 2 types of drawdown that I hate. So when it comes to the 3 types of drawdown, we have a balance-based drawdown, an equity-based drawdown, and a trailing drawdown. Now, the balance-based drawdown is the one you're used to. It's the one that makes sense. It's the one that's fair. It's to say that if I have a 100k account, I'm only allowed to lose 10%. After a 10% drawdown, when I've lost more than $10,000 on a $100,000 account, I'm out. I failed the challenge and I have to go buy a new one. That's fair. That's there to protect us, to make sure you're profitable and you're also not trading recklessly. Now, the problem is the other 2 types. And to be honest, I read through the website and I read certain terms and conditions where they're describing the equity-based drawdown and the trailing drawdown, and they word it in such a complicated way and use confusing terminology so people just don't get it. And therefore, the only way you understand it is when you lose your first account. So the next one is equity-based drawdown. So that's basically to say, if I start off with a 100k account, let's say I'm allowed a 10% margin, the maximum I can lose is $10,000. So the moment I go below 90k, I lose the account. And that's balance-based, meaning on closed positions. Once I've taken profit or hit stop loss, once I'm out of the trade, then that's going to update my balance. And then I see, am I on 89k? Then I've blown the account. If I'm on 92k, then I still have space to climb out of my drawdown. Now, unfortunately, the equity-based one is on unrealized profit. It's to say that even if you haven't closed the position, you can't lose more than the percentage they say. Let's say you're someone like me who trades high risk reward. I've shown a million times on many of my case studies or my track record, all my signals that I've done on Twitter, I can trade between a 3 to 7 pip stop loss. My average stop loss is about 4 to 5 pips. Let's say I take a trade with a 4 pip stop loss and I'm targeting London volatility. My TP, I'm going for a 1 to 10 risk reward. Just for example, I might take an entry on a trade and I might go into profit. And I'm like, okay, 1% up, 2% up, 3, 4, maybe I get to 7% up. I haven't taken a partial yet, for example. Now I'm 7% floating profit and I haven't closed the trade yet. Now let's say that position has a healthy retracement, a 40% retracement, a 50% retracement, and then it continues in my direction and then I finally close out for 10% profit. So in the end, what happened? A profitable trade. I made 10% profit and maybe I even passed the challenge. Well, in an equity-based drawdown, I might still fail that challenge. Now what these prop firms do is after a certain point in the day, they'll say, okay, that's your equity for the day. And if you go below that now, 5% or 10%, even if you didn't close a position, you lose the account. So for example, in the situation where I'm 7% up and then I have a retracement and it goes to just 2% up, floating profit, not a closed position. I actually went from 7 to 2. I lost 5% in unrealized profit. And then it went on and hit my TP and I locked in 10% profit. So my balance went from 100,000 to 110,000. I made 10% gain, but they saw that my equity, it went up to 7%, back down to 2%, and then continued to 10%. That's when I locked it in. So that portion in the middle where it went from +7 to +2, that was enough to violate an account. That is not fair. That is just a trick for you to fail. That is prop firms trying to grab your money. Now, when I mentioned about this online, certain traders were just coping. They were just like, oh, but it encourages you to take profit. Oh, but a sensible trader wouldn't even have that small of a stop loss. Oh, you shouldn't even be doing such high risk reward. This is just excuses for people to accept the nonsense that prop firms are doing. We shouldn't tolerate this because of course we can optimize. Yes, we can take partial earlier on. Yes, we can modify our strategy, but what are the domino effect of that? As I've mentioned in previous videos, your profit-taking system is as important as your risk management. Your profit-taking systems is detrimental because we optimize our profit-taking systems for data. Therefore, we don't optimize on a trade-by-trade basis. We optimize our portfolio. So skewing things in one way or another is going to have a ripple effect, a butterfly effect, way beyond what we just see because it might overall affect our profitability. It might even be enough to make us not profitable just by the way we manage our profits. Now, the last one that makes me angry is the trailing based drawdown. It's basically that if I start at a 100k account and then I make profit, let's say I make 110k and I'm up 10%. Initially, my margin for error would be what? If I started 100k, my max drawdown was $10,000, so I couldn't go below $90,000. So it starts at 100K, I can't go below 90K, and then when I make profit to 110K, well, now I have a $20,000 buffer because I can go from 110 back down to 100 and all the way down to 90K before I lose the account. So as you gain profits, you increase your buffer and therefore your drawdown can get larger and larger. And that's a safety net. Trailing drawdown is a drawdown that follows you. So if I make 10% profit, then my drawdown goes from 90,000 to 100,000. It always follows me. It trails me. So let's say I'm sitting on $110,000. I've made 10% gain. And then I have a losing period, a normal losing period that can happen. And maybe unfortunately I go from 110,000 all the way back down to 100,000. In a balance-based prop firm, that's completely fine. I didn't hit $90,000. I haven't breached the account. So I go through a little bit of a losing streak and I can build it back up. Now with a trailing based drawdown, it followed me. So even though I was 10% up, my account was at 110,000 and then I had a 10% loss and then I started back where I began at 100,000. That is enough to lose the account. Meaning to say they cut your buffer for no reason. You earned the buffer, you earned a bit of profit and they said, we're going to follow you. Now certain traders will say, but it instills good habits. It forces you not to have losing streaks. It forces you to follow good risk management, which is true. You should follow risk management. But why, if I've earned profit in an account, why would they trail my drawdown? Because that's not real life. That doesn't help anyone. That is only there for you to lose money in a normal situation where you can have a losing streak. Now that's not fair. So red flag number one is avoid the prop firms that do equity-based drawdown or trailing drawdown and only work with balance-based drawdown, because that is the only way that is going to be fair for us. The next red flag is how they trick you into believing something is a good deal versus a bad deal. Now prop firms know what we focus on. They know what the industry wants. They want cheap prices and easy profit targets. Okay, what's the cheapest one? Okay, this one's cheap and it's a 6% target. Let's work with them. But what they won't realize is what's the catch? Don't fall for the marketing gimmicks. Don't fall for the trap. They are only giving you a 6% profit target or an 8% profit target to invite your money. What they'll even do is they'll say you can do it in one phase, you can do it in 2 phases, or you can do it in 3 phases. So a friend of mine, Kimmel, which you've probably seen his YouTube videos, he actually gave me this idea of how about we make it a formula. Let's not just get lost in the numbers, but let's do it as a ratio between what is your max drawdown and what is the total profit target you need. So let's say you're doing a 2-phase challenge and your profit target is 10 and 5. So therefore you have 15% total profit gain and your max drawdown is 10%. You can go from 100,000 to 90,000. So if your max drawdown is 10%, your profit target is 15%, and then you do a division. Total profit target divided by max drawdown. In this case, it's 1.5. So in this case, this is reasonable. Then you find another prop firm that is, for example, it's a 6% target and a 6% target. So you think, okay, well, the other one, it was I had to get 10% in phase 1. This is now only 6%. I don't have to make an extra 4%. So you think that's perfect. But then what you won't realize is that prop firm will not give you a 10% drawdown. They'll give you maybe only a 5% drawdown. So then you realize you have 12% profit target, 6 plus 6, and then your max drawdown is only 5%. And then you divide that by the max drawdown. So let's say 5%. That means the result of that formula is 2.4. So in this case, that ratio is not as favorable as the 1.5 of the other firm. So just because it looked more appealing of 6 plus 6 doesn't mean it's a better deal. So what I would say is don't always go for the cheapest prop firm. Don't always go for the prop firm that has the less profit target, because they're going to do other things to make it harder for you anyway. Usually these firms are going to do the equity-based drawdown or the trailing drawdown, or probably have large slippage, or probably have large commissions or whatever. They're going to just make life harder for you. Rather work with a reputable prop firm that has reasonable targets. I think what's fair in this day and age is phase 1, 8%, phase 2, 5%. Anything around that is ideal. We don't need to chase lower and lower. The next one is slippage. Now, this is something that we all know about. We heard about the MFF situation where they had literally documents leaked saying slip them to hell. They were literally targeting traders to give them large slippage to lose accounts, and that's why they got shut down and that's why they got investigated by the US regulators. This is something that many prop firms are doing and we have to be careful. Therefore, it's important to work with a prop firm that has a good reputation. Certain prop firms, I won't name them, but they are known to do this. They are known to give you 10 pips slippage on EU regularly, and it's kind of like you just have to accept it. If you want to work with prop firms, you have to deal with it. That is nonsense once again. Work with a prop firm that is not going to give you slippage. If you have a 5 pip stop loss, they should respect your 5 pip stop loss and not just give you randomly a 10 pip stop loss and therefore double the amount of money you lose just by accident. And they'll say, oh, but you know, live trading conditions and that's the cost of Forex and brokerages do this too. Well, this is a simulated environment. This is not really live money. This is not really live market conditions. So therefore, they're only doing this for you to lose money. Don't tolerate that. Now, another red flag that you don't realize until it's the day of your payout, certain prop firms will only give you a payout after you have a minimum profit, which is strange because it's kind of like, if I make profit, I should get my payout. If I even make $100, I should get my profit split of that. And to be honest, that's a strategy that you should be doing. Let's say you've got a funded account now and you know you paid $500 for that account. Well, you know that the moment you lock in even just $100 of profit, you know that they will refund you your evaluation fee. So your objective is just lock in a very simple payout. So therefore you made a little bit of profit, you've got your profit split, and then you've also got your refund on your challenge fee. fee. So therefore that account is now risk-free because you took out your initial investment, and therefore you can use that to buy more and more accounts. That's the way we should approach this. Now, what certain prop firms do, they'll give you cheaper prices, they'll give you less profit targets, and they'll say, come trade with us, we have great conditions and all of these things. And then what will happen is you trade that account, you get funded, let's say, and then even you go on and you continue to trade it and you lock in, let's say, 1% gain. And you're like, okay, I've locked in 1%. I want my refund of my evaluation fee that I'm due. And then also I want to lock in my 1% payout. And therefore on a $100,000 account, you say, okay, 80-20 split. I want $800 plus my initial investment. That's great. Now what this prop firm will come back to you and say is, hey, well, you can't get a payout until you at least make, let's say 3% or let's say 5%. So they're basically saying, even if you make 2%, we're not going to pay you. Even if you make 1% gain, we're not going to pay you. You have to make a minimum profit for you to get your payout. Why is that? It's to force you to trade. It's to force you to trace a target, and it's to avoid them basically paying you out on your first $1,000 that you deserve. That is not for any benefit. That is only there for them to be cheeky, for them to save money and not pay you out. So what I'd say is avoid prop firms that are doing this, that are giving you minimum withdrawal targets. No, it's a prop firm. It's a live account. We agreed if I make profit, I get my payout on the agreed split. That's how it should be. Another red flag that you need to watch out for is don't go with the ones that your favorite influencer is promoting. Don't go with the prop firms that have the biggest Instagram pages or the best YouTube channel or whatever, because these are all marketing gimmicks. Look at their reputation. Look at their reviews. Look at what people talk about them online. If you find a prop firm that has a good price, they have hundreds of thousands of followers on Instagram, you even can see the CEO and you know who's behind it, but then you go on their Trustpilot or you look around on Twitter and all you see is payout denied, account access restricted, people making too much profit and then they cut them off randomly. The prop firms that fail your challenges because they felt like it, because they said, we did a review and we found this did not follow our terms. They give this approach of we are subjective and we can choose who we give an account to or not. And they'll basically say, if you're too profitable, if you have too many payouts, we're going to blacklist you. And that's happened to a lot of people that I know. So we have to be careful about these prop firms that are doing these dirty tricks, because they have the followers. They'll just say, okay, well, we don't need you. We got plenty of customers. But that's not honest, ethical approach. And I don't want to invest my money in a prop firm like that. Every influencer and their mom is starting a prop firm. There's hundreds to choose from. And some of them just started a month ago, 6 months ago. They are not true businesses. We need to work with the ones that have been around for 2 years, 3 years, 5 years, that have a stellar reputation and have stood the test of time. Now, the next red flag, I'm going to let you in on a little secret. Maybe you didn't know this, but prop firms, they need a little bit of tech. They need a software to actually run all of this on. Some prop firms build that themselves and they'll spend $200,000 or $500,000 building their own website, building their own infrastructure, building their own risk management systems, and actually building everything internally for everything that is required to actually sustain a prop firm. Now, a lot of the influencer-based ones, or a lot of these new prop firms that pop up, basically 95% of prop firms, they outsource that. They pay a tech provider to actually do all of this for them. And there's two main companies that are tech providers. One of them has their own prop firm. So you can already start to think, if there's one prop firm competing with 50 other prop firms that they are providing the tech solution to, they're purposefully never going to let other prop firms outshine them. They're not going to let them take their market share. So if we know that one prop firm is feeding many prop firms tech solutions, I don't want to be working with those ones, because this main prop firm is always going to make it worse for them so that they can be the best one. Second of all, and more importantly, is working with a tech provider and externalizing that component means that you have to pay them a percentage of your revenue. So certain prop firms that work with these tech providers, they pay them a setup cost and they also give them 30 to 40% of their revenue. Now, why is that important? Because right now there is a price war. Every prop firm is trying to get cheaper and cheaper and undercut each other. And that's great for the consumer because we just get the best prices. But the problem becomes is they're going to cut corners somewhere else. If they can provide a cheap service to you, it means they need to make you fail even more so that they can still make money, especially if they have to give 40% to a tech provider. Then they have to have about 25% of their revenue to pay out customers. Then they have their costs of maintaining a staff, marketing, website, all of these other costs. And then they also have to pay taxes. We can see that this 40% to the tech provider eats in hugely to their margins, but they're still trying to cut their prices, meaning that they are going to implode. Maybe one day they're not going to be able to pay out. And a lot of these prop firms that are around right now will not be around in 5 years because the founders, it's their first business. They don't have money to reinvest. And if they get big payouts, they'll go bust because they can't keep affording to do payouts because they pay 40% to the tech provider and then 20% in taxes, let's say. What's really left for them? Nothing. So we know that if they keep making it cheaper and cheaper and cheaper, we know that they're eating more and more into their profit margin, and eventually these prop firms will collapse. That's why I always say I would rather work with a prop firm that, even if it's a little bit more expensive to buy the evaluations, but if they have their own technology, well, that's 40% they don't have to give to anyone else. They can still afford to do payouts, and that's important because as a customer, as a user, as a trader, I want to make sure I'm working with a prop firm that is stable, that is sustainable, and that is not using all of their cash flow just to pay out. Now, a few little red flags are, for example, if they don't let you hold your trades over the night, or if they don't let you hold your trades over the weekend, or if they don't let you hold your trades over news. Now, that is up to me. If I'm trading and I have a strategy and I want to hold a trade overnight, I should be allowed to. If I want to hold it through a news event because I'm break even, I should be allowed to. If I even want to enter during a news event, it's a little bit risky, but if I want to, it's on on me. I choose to do that if I want to. If I want to hold a trade over the weekend because it hasn't met my profit target yet, it hasn't reached my TP, and I know that maybe next week on Tuesday it might hit, then I should be allowed to do that. So prop firms that are restricting us and they're saying it's to force you to take profit so you can always be growing your account, it's to stop you getting caught in news volatility. Sure, they're justifying it, but they're only doing that to give you a reason to put that condition there in the first place. The reality is a real trader doesn't need that. We don't need to be babysit. We don't need to be told how we should trade or whatever. They're not doing that to help us. They're only doing that so you're forced to take profit before you want to, so that your profits aren't as big as you want. So you're forced to take it before a news event, or you can't enter 30 minutes before a news event. But what if you get a valid entry and then the news event is the catalyst to hit your take profit? Well, you missed a good trade then. Or they force you to cut it over the weekend or overnight. It's basically only there to force your hand. It's to force you to make decisions you didn't want to make, to ultimately affect your profitability. Therefore, to me, it makes sense to work with a prop firm that is not doing that. Why would I make life harder for myself? If I'm allowed to do it based on my backtesting, based on my edge, based on my data, I should be allowed to do it because my goal is to make profits. And if that's what the prop firm wants, when we make money, you make money, then they should let us. But the reality is when we make money, they lose money. So they'll do these things and they'll convince you it's for us. That's a lie. So we have to be careful. So ladies and gents, that's my list of initial red flags. And you're probably thinking, damn, there's a lot. And to be honest, there's even more red flags. So maybe I'll make a part 2 and let me know in the comments if you want to hear more red flags from me. But the reality is we can't just focus on the cheap prop firm or the one that has the best marketing budget, because followers does not equal better prop firm, or cheaper price doesn't equal better prop firm, or less profit target doesn't mean better prop firm, because you have to realize all of these hidden things that they do to make us fail or to make life harder for us. So now that we know these things, we can start to see what we can avoid so that we don't keep losing money on prop firm challenges.